Tax-exempt municipal bonds are heading for their worst quarterly performance in more than 16 years. Yields are soaring amid a recent U.S. Treasury sell-off and, of course, the looming expiration of Build America bonds. Joining me now to discuss the market is Matt Fabian, Managing Director at Municipal Market Advisors. Within the past month, Matt has called muni bonds a fantastic deal. Matt, you still feeling the same way? I mean, we have had this big drop in price.
Well, once again, you have to really define what you're looking for. When you buy muni bonds, are you looking for income? Are you looking for capital gains? I mean, for if you are an income buyer, it is still a fantastic, it's even better opportunity to be out there buying bonds that simply people don't otherwise want to own. If you're looking for total return or asset preservation, again, just like I said a month ago, it's a difficult market for that, and you're probably better suited in treasuries or some other kind of cash-like product.
Now, once the end of the year passes, I mean, and the Build America bonds expiration happens, as everyone, for a while now, it's been a little more certain that it was going to happen. There was uncertainty previously. But now that we're going to have this sort of change at the year end and more supply in the tax-exempt market, do you think it's still going to take a while longer for that to be digested?
I think that issuers will pull back and that there won't be as much supply as there would have been had Build America bonds been extended. So because issuers will only push so many bonds into the market, yields will only rise so high until supply falls away. At the same time, as nominal yields, we are a nominal yield market. As nominal yields rise, retail buyers will be in, institutional buyers will enter the market. It's not going to be a very liquid place in the year coming. It's not going to be the kind of place where hedge funds and big dealer plays happen. Instead, it really is it'll be more of a retail buy and hold type market. Higher nominal yields will attract demand, but that's assuming that issuers don't keep pushing issuance into the market. I think that they probably will slow down, and that there will be. I mean, we're projecting from about $430 billion this year of issuance. We're projecting about 350 or even lower next year. So a market decline in overall issuance.
Now, talk to me a little bit about the interplay as well between what's been going on in the Treasury market and the municipal market, because it seems like that's also had an influence on this upswing in yields.
That's been the major, probably the major factor in municipal yields rising has been the drag from treasuries. Now normally munis would have outperformed that, right? Our yields would have risen, but not quite as much. But instead, we are probably moving step for step with treasuries, and that's because of the expiration of the Build America bond program, because of the fears over credit, frankly, because of just the lack of bond insurance. In the pre-crisis days, we had the bond insurers. Many more munis were AAA. People assumed that they were safer. It was an overall more liquid market, and people felt more comfortable investing. Now, with far fewer AAAs available, people are reasonably much more circumspect about what they're buying, and they're worried about what those bonds are going to be worth in 6 months. So so all of those things together have really contributed to a rising yields, and it's probably will continue to be the case next year.
Well, and doesn't sentiment, of course, play a big part as well? We've had some prominent folks, Meredith Whitney, of course, on 60 Minutes, talking about the dangers posed by the municipal market. And it's a market that has a pretty high retail participation, according to the Fed, about 37%. So, if I see on 60 Minutes as a retail investor that the muni market's going to melt down, aren't I going to call my broker and say, get my money out of there?
Well, I mean, the problem with most of the buyers in our market are essentially permanent owners, right? Retail buyers generally don't sell because the cost of buying, the cost of selling is very high. So when you're expecting to hold your bonds to maturity, and there's talk about default, you take that much more seriously than otherwise. It's not like a stock where you could just trade it or short it or do something else to sort of hedge your risk. When you're a retail investor, you really own that security. So talk about this credit collapse, we call it looming collapse of munis, which is everywhere, which will probably continue to be the case over the next 6 months. I mean, whether or not you believe it's actually going to happen, this kind of talk and rhetoric will continue. It will continue to scare investors. It's not so much about selling; it's more about not buying. That's the principal issue. So it undermines demand, both retail and institutional, and it certainly makes things less liquid and invites yields to be higher. So.
Okay, and Matt, you were just talking about sort of the sentiment effect on the muni market, and you might see less buying going into 2011. But we did see some outflows from some of the tax-exempt bonds in this last quarter, didn't we?
Enormous outflows, actually, from the tax-exempt mutual funds. Actually, by the end of the year, we estimate that they will have lost about half of their total inflows, that they had just before that happened. So, they had about $35 billion of inflows right before the outflow started, and they're probably going to wind up losing about half of that by year end.
Is there anything to stop that momentum going into 2011?
Well, normally the beginning of January is, a return of risk taking. I assume that will probably happen again, but you really can't be sure. If it doesn't happen, the market has been, for the first part of the selling in this, in the fourth quarter, it really did impact prices and pushed yields much higher. For the second half, there has been sufficient demand, either from retail investors or from dealers, to take down all of those bonds that are being sold. Does that continue into the new year? It's not clear. If we do get a return of risk taking, yes, things should get better. If we don't, then yields could definitely jump higher. Right off the bat.
Let's talk a little bit about the risk that is perceived to be associated with the muni market right now. And again, I go back to this commentary by Meredith Whitney that we could see $100 billion in defaults and losses related to the market. Most of the folks I've talked to who are in the muni market day in and day out do not think that is necessarily a credible figure. Do you agree with that? And if not, why isn't it?
Well, I do agree with that. I do agree that it's not a credible number. But at the same time, it's a possible number, right? So when you think about the muni market, when you think about all the things that could happen, sure, a wave of defaults is a possibility. Except you have to look at the reasonableness and I really focus on how much the less reasonable your expectations, the more evidence you need to support it. To look at municipal governments then hurting bondholders over other stakeholders in the governments, which was really a completely different thing than has ever happened before. You really do need a fair amount of evidence in order to say that. I just don't see it.
Well, what about that they would get wiped out to the point where all of the stakeholders would suffer losses?
Well, there are, let's take a step back. When you think about a state or a city, you have stakeholders in taxpayers, in service recipients, in employees, in intergovernmental partners, in vendors, and then you have bondholders and other creditors. Bondholders, as well as pensioners, are really very well protected, very well insulated against cash flow problems. If the other stakeholders so far have been burned somewhat, right? Issuers have instead chose, mostly to borrow, but there definitely have been efforts to raise taxes and also to cut spending. Increasingly, the spending cuts will be the case. Going forward, to say that defaults will happen, we'll say a complete reversal of that. And it all comes down to willingness. Safe sector, as I call them, general obligation, cities and states, they default when they choose to default, right? They make the decision. Yes, we are no longer going to pay bondholders. Instead, we're going to pay policemen. That's an issue of willingness. We really haven't seen that erosion of willingness yet. Will it happen? Maybe, but but looking at sort of past default statistics, looking at very current, right now the number of general obligation bonds that are in payment default is 0. The number of rated muni bonds in payment default is 25. Out of 25,000 rated municipal bonds, only 25 are in payment default. So will this wave of defaults happen? Maybe, but it hasn't started yet. And looking at the future, you have statements from all the big organizations, the big issuer organizations, as well as the governments themselves, saying that they are very willing to continue to make payments on time and in full. It's just hard to say. At what point, where is the trigger that would lead this, that would lead them then into payment default? I just don't see it. So it's just it's hard to allocate a portfolio based on something that you just don't have credible evidence for.
Well, we'll see if it starts to happen. And Matt, we'll definitely check back in with you in 2011 and start to figure out what exactly is going to be going on with the muni bond market at that time. Matt, Fabian, thank you so much for joining us. Happy New Year.
Thanks for having me. You too.
Thanks.